Hello friends, welcome to one more video on your favorite YouTube channel, Exam Prep. A new financial year has begun and I am confident all of you have already prepared your learning calendar. It makes absolute sense to learn new things every year and reskill yourself. You can depend on Exam Prep, which helps you to learn these skills through various types of questions which are posted on the channel from time to time. Even before I talk about risk management topic in detail, let me tell you that this particular video has been created considering two key examinations conducted by Indian Institute of Banking and Finance. The first exam is CAIIB, in which risk management is one of the electives. The second exam is Risk in Financial Services. I am using the book Risk Management published by Macmillan Education, and for preparing this video I have used the 2023 reprint edition. I am very happy to share with you that your favorite channel Exam Prep has already got more than 1000 subscribers. This would not have been possible without your help and cooperation. Please continue to like the videos that I place on this channel. Additionally, share these videos with your friends and help me increase the subscribers so that I can add value for all of you who aspire to get certified by NISM as well as IIBF for various courses and examinations that they conduct. There is a disclaimer that I have placed which is related to this video and in general also, that in September 2023 RBI came out with a new or rather a revised regulatory guideline on investment classification and valuation. Since this video is about market risk, these guidelines, the new guidelines are applicable to them, and that is why I am telling you that the video does not take into consideration this particular change because the textbook has not got these changes incorporated as far as the reprint edition of 2023 is concerned. Okay, so all our questions will not take into consideration these new changes which have been introduced by RBI because the book is yet to incorporate that. Having said that, let me take you through what exactly are we trying to do here in this particular video. So this video is about market risk, which I have already told you. I'm sure all of you know what is market risk, but just to make things simpler, market risk is defined as the risk of losses that a bank may experience in on and off balance sheet positions that arise from unfavorable movements in market price. So the emphasis here is on unfavorable movements in the market price. That's the point to be noted. If the market price movement is favorable, then you are not going to get impacted. So change in the market price does not essentially cause market risk. The market risk gets caused from unfavorable movement in the price. Let me elaborate this further. A buyer always gains when the market goes up, while a seller always gains when the market goes down, right? So it depends upon whether things are favorable for you or unfavorable for you. That is what will define the market risk. Well, market risk broadly covers four areas: interest rate risk, equity risk, commodity risk, and foreign exchange risk. Now, interest rate risk is to do with bond and related instruments. Equity price risk is with shares. Commodities could be multiple commodities, gold, silver, and agri commodities which could be there. And foreign exchange is obviously to do with the various currencies which are there outside the world, across the world. But I am also including liquidity risk because market risk is to do with buying and selling of various instruments, and when you sell them particularly or buy them, you may face liquidity risk and you may not be able to typically sell all your investments at the desired price, and that's why liquidity risk has also been added here. Let me now proceed with the questions. The first question that you see here is that market risk is also caused by liquidity of market in which assets are traded and the period required to liquidate the transaction. Is this statement true or false? Well, I had already told you that liquidity risk is also linked with the market risk, or is rather part of the market risk in a way. So this statement is definitely true, and we can safely mark it as true, because if you cannot liquidate or sell your assets, then obviously what would happen is that you will face this particular risk, which is what makes it true. Which of the following constitute part of trading book of a bank? And I'm again repeating here, which I told you earlier, we are taking the old guidelines and not new guidelines here. And using the old guideline, what we are doing is we are trying to answer this question. So which of the following constitute part of trading book of a bank? So available for sale and held for trading. Both these categories are basically part of what we call as the trading book. Okay, held till maturity along with some other things are part of banking book. Okay, so the answer that we'll go for is A and B. Now we'll move to the question number 3. Which of the following is not true about trading book? So trading book and banking book are two segregation of books of investment books of a bank. So which of the following is not true? So let us investigate this one by one. Then we will be able to understand this in a much better way. So what are we trying to investigate? So the first thing that we are looking at is that average size of the transactions in trading book is much larger than transactions in the banking book, which is true, right? Because you trade in huge volumes, you buy and sell in huge volumes. The intention of acquiring assets in trading book is to make short-term profits. Yes, that's absolutely true, because we like to make money quickly and as much as is possible from the movement in the market price. Investments in trading books are not mark to market. No, this is not true. Why? Because trading book, whenever you hold assets in a trading book, you are supposed to market to market. Trading book transactions are sometimes referred to as wholesale transaction, which is correct. So the answer C in this case is not true about trading book. This takes us to question 4. Which of the following are types of interest rate risk? So interest rate risk is a type of market risk, but effectively if you see prepayment risk, basis risk, yield curve risk, all of them are part of interest rate risk. So we can safely conclude that the answer is D. So what we learned from this particular question is that within a risk we may have various types of risk also. Okay, so when somebody tells you about credit risk, is talking about default risk. There is a delayed payment that can happen. There could be a risk that may arise because of insolvency and all those things, right? So one risk can be further bifurcated into different risks. Equity price risk is about general risk and specific risk, or systematic risk and unsystematic risk. So this is something that we need to understand. Question number 5. Which of the following risks get eliminated in case of diversified portfolio of equity? We all have heard that do not put all your eggs in one basket. So it is about the diversified portfolio. So once the diversification happens, what we call as the idiosyncratic risk, okay, which are specific to a company, these risks get eliminated, if not fully, then definitely significantly. Let us move on to question 6, because we have done with the 5. Okay, which of the following factors cause gap risk in foreign currency? Now gap risk is one of the feature of foreign currency, because there are different transactions done for different time frame. You can have 1 month, 2 month, 6 months transaction, multiple types of forward transactions which can also be done. So movement in the spot exchange rate between two currencies, if it's not uniform, then there could be a gap risk. And interest rate differentials of two currencies also cause the gap risk which arises between the quotations or the values. So the answer for this would be both of the above. So we have completed 6 questions. Let us move on to the 7th one. Which of the following risk is the risk that an investor holds, that an investor will face, who is holding the security till maturity? What should be the focus of that kind of an investor who is holding a security till maturity? Well, price risk is not a concern because you are holding it till maturity. So anyway, you will get the investment that you have made. Liquidity risk is also not a concern because since you are holding it till maturity, you are not going to sell it. So your risk focus is on reinvestment risk, right? Now we go to the question 8. If the interest rate goes up, price risk will increase, but reinvestment risk will decrease. So price risk increases and reinvestment risk decreases. Why does this happen? Because when interest rates go up, the price of a bond falls, while the reinvestment income that you make from the coupon, that will keep on increasing because you are getting a higher return on the reinvestment, right? So every time when there is a change in the interest rate, there are two impacts of it. One, impact on the bond price, and two, impact on the reinvestment income that you make from coupons, right? So coupons are paid periodically, okay, by the issuer. So if you have coupons which you are getting from the issuer, there would be a reinvestment risk. Which of the following is not the outcome of liquidity risk? So we know that liquidity risk is a key risk when you try to liquidate your assets or sell your assets. So which could not be the outcome of liquidity risk? So we have to find one from the four options. Adverse change in market price, inability to liquidate positions at a fair market price, inability of or rather inability to liquidate position at any price, and lower bid ask spread. Of course, when liquidity risk is higher, the bid ask spread is also higher, so lower bid ask spread will not be applicable. In fact, bid ask spread goes up when the liquidity risk is high. So the outcome of liquidity risk is adverse change in the market price. That can also happen because you're not getting the price that you thought you will get, and you will be able to liquidate. So we have removed the A, B and C. So the answer is D. Dash 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 is a risk mitigation strategy that matches assets and liabilities duration so portfolio values are protected against interest rate change. What could be that strategy? We have different strategy which is used in the fixed income market, barbell, bullet, ladder. But this strategy which takes care of your interest rate risk, okay, we are categorizing it as immunization. So immunization basically protects an investor by balancing the change in the price of a bond and reinvestment income of a bond. So what will happen is that if the price falls more than the reinvestment gains, then you will have an overall loss. So immunization in a way takes care of that part. Let us move on to question number 11. Which of the following are responsibilities of ALCO? ALCO stands for Asset Liabilities Committee. So let us see which is it. Product pricing for deposits and advances. Obviously, that's their responsibility. Deciding on desired maturity profile and mix of incremental assets and liabilities, which is also the responsibility of ALCO. Articulating interest rate view of the bank, which is absolutely true. Deciding the risk management policy of the bank. No, this is done by the board of directors. So we will go with option 1, 2 and 3, which is C. Now we are left with 4 questions. I hope your journey so far in this video has been interesting. Which of the following keeps a close eye on risk appetite and compliance of risk management policies of a bank? So we have front office, middle office and back office, but this job is typically performed by the mid office, right? Mid office is the watchdog actually, and it is responsible for doing this. And this segregation of front office, middle office and back office also reduces operational risk in the banking procedures. Reporting of uses of risk against limits established by the risk management committee should be maintained by the back office of the dealing room, right? So the answer would be back office for this particular question, right? So this is something where you are reporting the limits established, okay, and this has to be maintained, okay, the data and the records have to be maintained by back office. Dash 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 is defined as the gaps between value predicted through market risk and value actually observed. Well, this is what we call as the model risk. Model risk means the model that you have built to predict the risk, okay, or to observe the risk, how much of difference that you find actually between what you predicted and what was observed. That is what we will call as the model risk. And the last question that we will take up now is, which of the following is least likely to cause a model risk? And the word is least likely, right? Please do not forget that. Incorrect assumptions, yes, that will cause. Incorrect judgment in dealing with outliers, true. Incorrect categorization of risk, this is something which will cause, the model risk in a least possible way, right? So we go with the answer C. Insufficient data points will also cause model risk. Now I have covered 15 questions and I'm sure it has added value for you. Please do not forget to subscribe to this channel and like this video and also share it with your friends. Thank you.